$10 trillion in wealth destroyed, 8.8 million Americans unemployed, millions lost their homes, and after the biggest financial fraud in modern history, guess how many Wall Street CEOs went to jail? 0. Actually, one person went to jail, Kareem Sarageldin, a mid-level Credit Suisse trader, not the CEOs of Goldman Sachs, Citigroup, or Lehman Brothers. This is the 2008 financial crisis, and it's worse than you think. After the dot-com bubble burst in 2000, the Federal Reserve slashed interest rates. Borrowing became incredibly cheap. Housing prices had been rising for decades. Everyone believed one simple myth: housing prices never go down nationwide. Banks started handing out mortgages to anyone. Ninja loans, no income, no job, no assets. People who couldn't afford used cars were buying $500,000 homes with adjustable rate mortgages. Payments looked affordable at first, but would skyrocket after a few years. Here's where it gets insane. Banks weren't keeping these toxic mortgages. They were selling them to Wall Street. Investment banks like Goldman Sachs and Lehman Brothers bundled thousands of mortgages into mortgage-backed securities, or MBS. They sliced these into different tranches, different risk levels. Safest tranches got paid first, riskiest got paid last, but with higher returns. Then it got crazier. They bundled these mortgage-backed securities into collateralized debt obligations, or CDOs, securities made from securities. Then they created synthetic CDOs, bets on whether the original CDOs would succeed or fail. By 2006, there was $5 trillion in synthetic CDOs alone, money created from thin air, all based on mortgages given to people who couldn't afford them. But didn't anyone check if these were safe? Yes, rating agencies like Moody's and Standard & Poor's. Between 2000 and 2007, Moody's rated nearly 45,000 mortgage-related securities. Over half got AAA ratings, the same rating as US Treasury bonds. Here's the con. Rating agencies were paid by the banks creating these securities. If Moody's didn't give a good rating, banks went to Standard & Poor's instead. The agencies competed to give the best ratings. Students paying for their own grades, everyone got straight A's. These AAA ratings meant pension funds and foreign governments bought these securities thinking they were ultra safe. By December 2008, there were over $11 trillion in structured finance securities outstanding. The biggest house of cards in history. Wall Street got filthy rich. Fees for originating mortgages, packaging them into MBS, bundling those into CDOs. Banks paid traders massive bonuses based on short-term deals, not whether investments would actually work. Countrywide Financial, one of America's largest mortgage lenders, was on a rampage. CEO Angelo Mozilo personally approved loans he knew would default. Internal emails showed executives joking about giving loans to people with bad breath. It didn't matter. They'd sell the mortgages to Wall Street within weeks. Then reality hit. In 2007, housing prices stopped rising. Adjustable rate mortgages reset to higher payments. People couldn't afford homes anymore. By December 2006, 10% of subprime mortgages were over 60 days delinquent. Double the previous year. The system collapsed, mortgages defaulted, MBS lost value, CDOs became worthless. Nobody understood what was in these securities anymore. Panic spread. Rating agencies downgraded nearly $2 trillion in mortgage securities. By late 2008, 80% of AAA-rated CDOs had been downgraded to junk. Bear Stearns collapsed in March 2008. In September, Lehman Brothers filed for bankruptcy, the largest in US history. AIG needed a $182 billion bailout. Merrill Lynch was sold in a fire sale. The global financial system was hours from total collapse. Credit froze. Banks stopped lending. Stock markets crashed. The Dow lost over half its value. Unemployment hit 10%. Home prices fell 20%. $30 trillion in wealth destroyed globally. The government launched TARP, $700 billion to bail out banks. The Fed dropped interest rates to near zero. The alternative was another Great Depression. What happened to those responsible? Banks paid fines. Bank of America, $17 billion. JP Morgan, $13 billion. Goldman Sachs, $5 billion. Civil settlements from corporate funds, not personal accountability. Banks treated fines as a cost of doing business. Criminal prosecutions. During the 1980s savings and loan crisis, over 1,000 bankers were convicted. After 2008, essentially zero. No Lehman CEO charged, nobody from Citigroup jailed, no Bear Stearns executives indicted. Angelo Mazzillo paid a $67.5 million fine, but admitted no wrongdoing. Only Kareem Seragaldin served time, 30 months for lying about security values. The judge acknowledged he was a small piece of the overall evil climate within the bank and with many other banks. He was the scapegoat while CEOs walked free. Why no jail time? Attorney General Eric Holder claimed no proof of criminal intent. Too complex for juries. After the crisis, only 120 FBI agents worked on bank fraud. During the S&L crisis, 1,000 agents. Others cite the Holder Doctrine, a 1999 memo about considering collateral consequences when charging corporations. Translation: banks were too big to jail. The government feared prosecuting major banks would destabilize the economy, like when Arthur Andersen collapsed after Enron. Banks paid fines and promised reform. CEOs kept jobs and bonuses. JP Morgan CEO Jamie Dimon told CNBC, "Failure is not illegal. You make investments. They don't always pay off. It doesn't mean you're a criminal." Except it wasn't just failure. Internal emails showed executives knew they were selling garbage. Credit Suisse traders joked about the vomit they sold to clients. Goldman Sachs created CDOs designed to fail so they could bet against them. Banks foreclosed on homes they didn't even own mortgages to. This wasn't incompetence. It was fraud. Today, we're still living with the consequences. Post-crisis, regulations weakened. Income inequality exploded as wealthy investors recovered while working families lost everything. An entire generation distrusts Wall Street and government. Similar risky practices are creeping back. The 2008 financial crisis wasn't just a market failure, it was a complete breakdown of accountability. Wall Street gambled with other people's money, crashed the global economy, got bailed out by taxpayers, paid themselves billions in bonuses, and nobody went to jail. They privatized the gains and socialized the losses, and we're all still paying for it. Speaking of financial systems that don't work as advertised, click this video to see another fascinating business story. I'll see you there.